Folks, the Fed came out with a decision. They're lowering rates. What does it mean to you? What does it mean for your account? What does it mean for the stock market? What does it mean for the bond market? Is there going to be another rate drop this year? Let's talk about all of this in today's video and figure out how it's going to impact you and your portfolio. First, be sure to take a moment to sign up for my big reveal. Everyone's been asking me the best way to get ahead in these challenging markets. So this week, I'm pulling back the curtain on my secret to generate massive gains on NASDAQ stocks and options in 2 weeks or less. I want my followers to end this year on a strong note. Click the button below to reserve your spot. Do it now. All right, so the Fed lowered rates. Lower rates are typically very positive for the stock market. But here's the problem. We have tariffs. Tariff war. Till China and Trump sit down and actually come up with a solid plan, this is going to loom on the stock market. It's like a wet blanket. So the Fed has to keep rates really, really low. And the Fed even said they may lower rates again before the end of the year. That's going to keep bonds higher, interest rates lower, and that's going to keep the market above the 50-day moving average. Unless we hear or see something negative like bad employment numbers or a slowdown in industrial production and retail. Otherwise, expect the stock market to be range bound and a few strong stocks outperform. But the majority, the S&P 500, shall stay choppy because there's no major catalyst for upside right now. And honestly, the only thing that's keeping stock market so strong is the Fed giving us more promises of lower and lower rates. Otherwise, the stock market would begin to falter and we would see a lot more trading near the 200-day moving average. Now, if we keep lowering rates, it'll inflate the stock market. But remember, rates are already around 2%. I mean, how much lower will they go? So again, for the next month or two, being long bonds is a very smart move because bonds give you some defensive. If stocks go down, bonds will rise, flight to quality. And with the Fed saying they're going to cut rates some more towards the end of the year or between now and the end of the year, it's more likely than not. The scenario is telling us more likely than not, it's playing out with long bond, ticker symbol TLT if you trade ETFs. If not, the 30-year or the 10-year bond, it's going to go a little higher. It's already in a strong uptrend. It's pulling back a little bit. It may be a good time to initiate a defensive bond or a gold position. I'm not bearish on the stock market yet, not even close, but I do believe we're going to see a lot more choppy sideways trading action till there's more resolution with China. I believe lowering rates right now will only keep the stock market strong, but it won't keep it from really going lower. It'll keep it from going higher unless we see a catalyst. We've got to see a major catalyst, and we're not seeing one right now. Earnings expectations are a little lower. Employment data is humming along, but again, China is a major issue. Until small caps start rising, till the Russell 2000 begins rising, we're going to see the S&P 500, the Dow, and the New York Stock Exchange show us a very choppy sideways climate. So keep your eye on the bond market. Keep your eye out on the small caps. Hopefully that helps. Did you save your seat for my newest announcement? Do it now. I'm sharing my strategy that's earned 80.9% average annual returns since 2010. With those numbers, every $10,000 would be $20,000 in 12 months, $324,000 in 5 years, and over $10 million in 10 years. This event could change everything for you. Don't miss it. Sign up below now. You'll be hearing from me right after.